If you ask 10 rich people whether real estate or stocks are better, you will probably get 12 opinions, 2 ego contests, and one guy saying, "Bro, buy land." They're not making any more of it. Meanwhile, the stock market crowd is sitting quietly in the corner with an index fund and a smug smile. Real estate investors think stocks are too abstract, too emotional, and too dependent on Wall Street. Stock investors think real estate is just a part-time job with plumbing. So who is right? Today, we are not doing lazy internet advice. No, just buy assets. No fake guru math. No pretending repairs, taxes, vacancies, and time do not exist. We are looking at the real comparison between real estate and stocks in plain English with simple math and answering the question people actually care about: which one will make you more money? Here is the short answer. It depends on 3 things. 1. Leverage. 2. Time and effort. 3. Your actual behavior. And if we compare them honestly, stocks are usually the better passive investment, while real estate can outperform if you use leverage well and manage it well. That is the real answer. Now let us walk through it. First, we need fair rules. This is where most bad comparisons fall apart. If someone buys a rental property with 20% down, they are controlling a much bigger asset with a smaller amount of cash. If you compare that to someone who simply puts the same cash into stocks, you are not comparing equal assets. You are comparing leveraged real estate to unleveraged stocks. Of course, the result looks different. That is the whole point of leverage. So let us make it simple. Imagine you have $100,000. You have 2 choices. Option 1, invest the full $100,000 in a broad stock index fund. Option 2, use the $100,000 as a 20% down payment on a $500,000 rental property. Same starting cash, same investor, same moment in time. Now we can do real math. 1. Stocks are simple, boring, and incredibly powerful. Historically, the U.S. stock market has returned around 10% per year on average before inflation over the long term. Not every year, obviously. Some years are great. Some years feel like your portfolio got into a fight behind a gas station. But over decades, that 10% range is a useful rule of thumb. So if you invest $100,000 in a broad index fund, a decent long-term expectation might look something like this. After 10 years, around $260,000. After 20 years, around $670,000. After 30 years, around $1.7 million. That is the magic of compounding. And the beauty of stocks is not just the return. It is the simplicity. No tenants, no repairs, no roof, no late-night call that starts with, "Hey, this is probably nothing, but there is water coming through the ceiling." Stocks are liquid, diversified, easy to automate, and very hard to beat on convenience. If you keep investing, reinvest dividends, and avoid panic selling every time the news says markets in turmoil, stocks quietly do what they do best. They grow. Now let us talk about real estate, because this is where things get more interesting. 2. Real estate has more moving parts and more ways to win. Real estate investors are not crazy when they brag about rental properties. A rental can make money in 4 ways. 1. Appreciation. 2. Cash flow. 3. Mortgage paydown. 4. Tax benefits. Stocks mostly give you growth plus dividends. Real estate gives you more levers. That can be a major advantage, but it also means more complexity. Let us use simple numbers. You buy a $500,000 rental property with $100,000 down. Let us say the property grows in value by 4% a year. That means in year 1, the property goes up by about $20,000. And this is the big real estate trick. You only invested $100,000, but you got appreciation on the full $500,000. That is leverage. A fairly normal 4% increase in the property creates a 20% gain on your original cash, at least on paper. That is why real estate gets people excited. Leverage makes average growth look impressive. Now add rent. Let us say the property brings in enough rent that after mortgage, taxes, insurance, maintenance, vacancy, and management, you are left with maybe a few $1,000s in positive cash flow per year. Nothing crazy, maybe $3,000 to $5,000. Then add mortgage paydown. In the early years, maybe your tenants help knock another few thousand off the loan balance. Call it another $4,000 or so. So in a decent year, your real estate return might look something like this. Around $20,000 from appreciation, a few thousand from cash flow, and a few thousand from principal paydown. Very roughly, maybe $25,000 to $30,000 in total benefit on your $100,000 investment. That sounds amazing. And sometimes it is. But here's the catch. Real estate is not clean math. It is messy math. That return depends on the market, the property, the rent, the interest rate, the tenant, and whether the furnace decides to die the week after you bought new tires. 3. Leverage is real estate's superpower and its biggest risk. This is the key to the whole debate. Real estate often beats stocks because of leverage. With $100,000, you can control a $500,000 asset. If that asset goes up, your return on cash can look fantastic. But leverage is not magic. It is gasoline. If things go well, it helps. If things go badly, it helps badly. If your $500,000 property rises 4%, you gain $20,000. Great. But if it falls 10%, the property loses $50,000 in value. That is half your original $100,000 equity gone on paper. Meanwhile, if your $100,000 stock portfolio falls 10%, you are down $10,000. Still painful, but much easier to survive emotionally. This is why real estate investors can look brilliant in rising markets and suddenly become philosophers in falling ones. Leverage magnifies outcomes. That is the power, and that is the danger. 4. Cash flow sounds great until reality walks in wearing work boots. A lot of people love real estate because it pays every month, and that is true. Cash flow can be wonderful. It can help pay bills, reduce dependence on a job, and feel much more tangible than a stock chart. But the keyword is net cash flow, not gross rent. Too many people hear, "This property rents for $4,000 a month," and immediately imagine passive income and freedom. Then reality arrives. Property taxes, insurance, repairs, vacancy, turnover, management, appliances, legal costs, time, stress. Suddenly that passive income starts looking suspiciously active. That does not mean cash flow is fake. It just means it has to be calculated honestly. Some markets produce great cash flow. Some produce almost none. In some cities, investors are basically betting on appreciation and hoping the rent covers enough of the bills to keep them alive. Stocks, by contrast, have a hidden superpower. They are ridiculously low maintenance. If you own an index fund, Microsoft is not texting you on Sunday morning because the sink backed up again. 5. Stocks usually win on simplicity, diversification, and scalability. This is the boring part, which is exactly why it matters. Stocks are easy. With one fund, you can own hundreds of companies in minutes. If you want to invest another $500 next month, easy. Another $1,000 the month after that, easy. Stocks scale beautifully. Real estate is lumpy. You usually need more capital, financing approval, inspections, paperwork, and the ability to look calm while signing documents that seem longer than a small novel. You are also concentrated. One property means one neighborhood, one local market, one structure, one set of tenants, and one possible surprise under the floorboards. This is why stocks are usually the better choice for the average person who wants long-term wealth without another job. They are easier to automate, easier to diversify, easier to hold, and harder to mess up with complexity. Real estate can absolutely beat stocks, but usually when the investor adds skill, they buy well. They improve the property, they raise rents, they cut costs, they refinance smartly, they manage risk. At that point, they are not just investing, they are operating a business. 6. Taxes give real estate another edge. This is one area where real estate often looks very attractive. Rental owners can deduct expenses, write off mortgage interest, and use depreciation, which is one of the strangest gifts in the tax code. Your property may go up in market value, while the tax system lets you pretend part of it is wearing out every year. That can reduce taxable income and improve after-tax returns. Stocks are simpler, but usually less flexible in a taxable account. You may owe taxes on dividends, and if you sell for a gain, you may owe capital gains tax. Retirement accounts help, of course, but in plain taxable investing, real estate often has more tax tools. That said, tax benefits do not rescue bad investments. Buying a terrible property just because it has write-offs is like crashing your car because you wanted the insurance claim. Technically, something happened. Financially, not ideal. 7. The biggest factor is not math. It is behavior. This is the part people hate because spreadsheets are easier than honesty. The best investment is often the one you can actually stick with. Some people cannot handle stock market volatility. If their portfolio drops 20% or 30%, they panic, sell, and destroy their own returns. For them, real estate may actually be easier to hold because it is less liquid. They cannot check the value every 5 minutes and emotionally self-destruct before lunch. Other people hate dealing with tenants, contractors, paperwork, repairs, and all the little dramas that come with physical property. For them, real estate is not freedom, it is stress with a mortgage. They would probably make more money buying index funds automatically and then doing literally anything else with their weekends. So ask the honest question, which one fits your temperament? Because the perfect investment that you quit is worse than the slightly less perfect one you can hold for 20 years. 8. So which one will make you more money? Here is the honest answer. If you are an average investor with a normal job who wants the most passive, scalable, and durable path to wealth, stocks will probably make you more money on a risk-adjusted and time-adjusted basis. They are simple, diversified, low maintenance, and very effective over long periods. But if you're willing to use leverage, choose properties carefully, manage the details, accept some illiquidity, and treat real estate like a business, real estate can absolutely outperform stocks. Especially if you buy well, hold for a long time, and let appreciation, rent, and loan paydown work together. So the real answer is this: stocks are usually the better passive investment. Real estate is often the better active wealth-building strategy. Not real estate always wins, not stocks are always better. The truth is more useful than that. Real estate gives you leverage, tax advantages, and multiple engines of return, but also more work, more friction, and more concentration risk. Stocks give you simplicity, liquidity, diversification, and effortless compounding, but usually less leverage and less control. And if you want the least dramatic answer, which is often the smartest answer, here it is. Many of the real winners use both: stocks for passive compounding, real estate for leverage growth. One scales with clicks, the other scales with skill. So the next time someone asks, real estate or stocks, do not answer like it is a sports rivalry. Ask better questions. Are we using leverage? Are we counting all expenses? Are we including taxes? Are we measuring effort? Are we comparing equal risk? And most importantly, which one can you actually execute consistently without sabotaging yourself? Because in the real world, the best investment is not the one that wins arguments online. It is the one that helps you build lasting wealth without blowing up your life in the process. And that is the real math.